Hello and welcome, everyone. I'm Shayna Kosh, your host for today's webinar. Thank you so much for your investment of time. I truly don't take that lightly. And in fact, I have one goal for you today, and that is to replace uncertainty with a clear structure for how to evaluate opportunities and make confident decisions. Each of our panelists is going to share their perspective for about 8 to 10 minutes, and then I'm going to connect the dots and we'll open it up for live Q&A. Now, please be mindful. There is no such thing as a silly question. In fact, the only unfortunate question is the one you don't ask. So please engage and let's have some fun. But first, let's get started with a question. I want to do an audience poll. I'm just curious, where is everyone in their investment journey? So by utilizing chat, press 1 if you're just curious about real estate investing. Press 2 if you're considering buying a first investment property. 3 if you already own one or more investment properties. And 4 if you're actively expanding a portfolio. All right. Looks like we have a mix of people who are just starting to explore and some who already own property, which is perfect. That mix is exactly why we structured tonight's panel the way we did. All right, without further ado, let me introduce Scott Brown. He's our real estate attorney tonight with over 2 decades of experience advising investors, developers, and property owners. He brings both transactional and litigation insight, which means he's seen what works and what breaks. Scott, can you tell us more about why legal structure is important?
Good evening, everyone. My name is Scott Brown. I've been practicing law in the state of California for 24 years, primarily as a litigator. So I only deal with things when they go south. But later on in my career, over the last probably 8 or 9 years, I've been doing a lot more transactional work. So I've been able to take that experience as a litigator and now start focusing a lot on helping avoid problems. And just wanted to briefly say that that's one of the biggest problems that people have with, whether or not to seek advice from a lawyer, is that lawyers are much better at preventive medicine than we are at curing cancer once you have it. So a lot of people are adverse to getting a lawyer until they have a problem, and that's not the time to do it. So if you're thinking about investing in real estate, it's really important that you get into a connection or a contact with a lawyer to help you structure what you're going to do before you do it. So first thing I would say to anybody who's looking to buy a property exclusively for investment is that you contact a lawyer, talk about what kind of entity that he or she might recommend that you pursue. I like limited liability companies. That is usually my preference for my clients. And the important thing is that what you want to do is when you start going into this world is that you want to separate everything that you've accumulated in your life from what you're about to do. And that limited liability company, for example, will be that demarcation between your previous life and your new life. And so a limited liability company allows you to separate your assets, everything you have, from what that business venture is going to be. And that's either if you're going to buy a property to then lease it to tenants, or you're going to buy property for the purposes of flipping. I'm not even going to talk about short-term rentals and things like that, but those two are primarily where my focus is. So a limited liability allows you to minimize your risks, allows you to basically compartmentalize the business venture from your home. And there's a lot that goes into it. Like I said, you most certainly need to get a lawyer because there's corporate formalities that you have to follow. You have to make sure your books and records are separated. You can't, buy pizza for your family out of the account for the LLC. You got to make sure that you're following all the rules in order to get the protection. In California, a limited liability company is treated like a separate person, all by themselves, as long as you treat it as a separate person. So I would definitely recommend that you do so. The next thing is, if you are an investor who's thinking about not just with respect to one property, but you're going to do multiple different properties, my recommendation, and again, I would recommend you get a lawyer that give you advice on those issues, but each property should be owned by a separate LLC. And that keeps a problem that arises with one property from then infecting multiple properties. If one goes south, you want to contain that, encapsulate that problem so that it doesn't continue to infect the other properties. If someone gets a judgment against that LLC and they're able to show that there's somehow blending or taking assets from one and using it for the other, it can then infest your entire portfolio. So I would recommend you do that prior to buying property. One thing that I often have my clients do is they'll form a limited liability that will be for the purposes of submitting purchase offers for property. And then once that escrow gets open, I'll have them open another LLC, transfer that purchase and sale agreement into that specific LLC. So if it's on Elm Street, it'll be 123 Elm Street LLC, and that will be the LLC for that property for the entirety of the time that you own it. It's also beneficial if you have investors that are going into the venture with you. You each can be membership certificate holders. You have an operating agreement that manages that property, but most certainly you should have a separate LLC or S Corp or whatever your legal representation wants you to do. But you want to make sure that there's no blending of those assets, bank accounts. You want everything to be self-contained with respect to that property. LLCs also have benefit of pass-through taxation. I tell my clients that if you're going to get into business, you should have at least 5 very trusted advisors. You should have a CPA that you trust. You should have an insurance broker you trust. You should have a lawyer you trust, a real estate agent. They usually have access to great opportunities prior to everyone else finding out about them. So you should absolutely have a real estate agent that you trust. And then finally, you should have a general contractor you trust. Each one of those failures to get those things in a row can absolutely destroy a person financially. The general contractor I cannot emphasize this enough. I do a lot of construction defect. I represent a lot of contractors and homeowners against contractors. Get a relationship with a general contractor early. You don't want to use a normal inspector to look at a potential investment. You want a contractor who's going to walk that property before your inspection contingency is up, and it's going to be able to tell you what's involved, what they see with their own eyes, how much it's going to cost. Have a conversation with that contractor as to what you envision doing, and that you have that information going in before the contingency period is up. And that means if you're interested in flipping it, you want to know what's going to be involved to do it. What are potential issues you're going to have? A trained eye is going to see those things, and they're going to call it out. Unfortunately, a lot of the inspection companies out there, they seem to adverse from liability. So you want to have a contractor. There's no requirement that you actually use a inspection company. You can use a contractor to do that. And then once you do close on the property, I can't stress this enough, use a licensed contractor. Don't try to do the work yourself. I've dealt with a lot of problems where Investors will buy a piece of property for flipping. They intend to do the work themselves. They do it as an owner builder, but there are requirements in Los Angeles where if you're going to be an owner builder, you have to follow the requirement. One of them is that you have to live there for 12 months. And a lot of people don't. So you want to make sure you're hiring licensed contractors. You want to make sure you have that warranty benefit of the contractor's work. It's transferred to the new owner that buys the property. You want to make sure that contractor, check them out on the CSLB, ask for referrals, see their work that they've done in the past, and make sure that they're qualified for what you need them to do. But don't wait too long. Don't look at a property, put an offer down, close escrow, and then go ask a contractor. You want to know as early as possible about what it's going to cost for what you intend to do with the property. We talked about the past benefits of tax benefits of LLCs. Get a CPA. I'm not a tax professional, but there are some benefits to having a limited liability company. You want to make sure you keep all your receipts. You want to make sure for capital gains purposes, everything that you do, you want to make sure you keep copies of those records. You have a CPA that's checking your six, so to speak, and make sure that you're following the rules necessary to take those proper deductions. And then with pass-through taxation, it's an individual obligation, so you're not paying taxes on it twice. The contractor relationship, make sure that they have appropriate levels of coverage. Workers' compensation is something you absolutely want to make sure that the contractor is not claimed exempt with the CSLB. So if they do and they have workers on the property and somebody gets hurt, that's going to be potentially on you if a labor gets hurt on the property and they're not covered under workers' comp. So make sure that you get an insurance certificate naming you as an additional insured before work is done. Make sure that the workers' compensation is up to date. Ask for verification that each one of the laborers that are going to be working on the property are covered under their workers' compensation. And it's not just to, protect you while you own the property. It's going to protect you after you sell it. You want to be able to point to the general contractor that they're responsible for the problems that have arisen, and it's not you as the seller. Limited liability companies offer you some privacy. Oftentimes people don't want to have their personal name on title for obvious reasons. If someone did an asset search on you or what have you, you don't want them to automatically know that this property is yours. Some people don't want that to happen. There are some disclosure obligations in California. I have some clients that open up a Delaware LLC, which do not have those requirements of disclosure of who owns the business. And then that LLC owns the membership interests in California LLC. So your expert can help you, or excuse me, your lawyer can help you structure it in a way if privacy is something that you is important to you. So just in closing, as I said before, don't wait until you have property. Make sure you get it. You get in touch with a lawyer prior to venturing into this what can be a very difficult arena, especially for the uninitiated. So go to a lawyer before you start, not after a problem arises.
Thank you, Scott. So structure starts legally. Once we understand how to protect ourselves, we can talk about capital. Next, we're going to hear from our lender, Tom McMurray. He's a seasoned mortgage broker with more than 25 years of experience helping buyers and investors Structure capital strategically. Tom, from a financing standpoint, what are your recommendations for investors?
Hey, Shana. Good evening, everybody. Thanks for joining us. Over my career, I've had the privilege of helping people from all walks of life, and I've found many of them want to invest in real estate, but find it too complicated or out of reach, especially when it comes to the financing piece. So my goal tonight is to shed some light on how investors actually finance deals in the real world and hopefully simplify that process a little bit for you. Let's start with a few myths that tend to stop people in their tracks before they even get started. Most people feel that you need to have a huge down payment, you have to have perfect credit, maybe make a lot of money, maybe all three. But the reality is, all of these things are not needed if you have the right strategy. So I want you to think about financing as a toolbox with different types of tools for different types of situations. Hit the next slide, Shana. Actually, 2 slides. There we go. So, in my opinion, and I may be a little biased, I think many investors fail not because of a bad deal, but because they just don't understand their financing options appropriately. So, each one of these financing types serves a different purpose, which I'll explain in a moment. And understanding financing options makes investing much simpler. So let's start with conventional loans, which are going to be the most common and usually the best starting point. So this is going to be the traditional or standard approval process that some of you may be familiar with. It's what we call full documentation. So you're going to provide pay stubs, W-2 forms, bank statements, tax returns in some cases. So this is going to be best for those investors with strong credit and stable income. Typical down payments for a single family home or a condo are going to be 15 to 20% down. 15% is technically available, but 20% certainly is the more common option. If you're looking at multi-unit properties, 2 to 4 units, that's going to require 25% or more down. And once you get into 5 units or more, that's considered commercial, and that's a completely different animal. So in summary, the conventional option is going to be the lowest rate, best terms, and ideal for long-term investments. The next option is going to be DSCR, which stands for Debt Service Coverage Ratio, which simply means instead of using your personal income like on a conventional loan to qualify, we're going to use the cash flow or the rental income from the property itself to help qualify. So for instance, let's say the property rents for $4,000 a month and the monthly payment is $4,000 a month, including taxes and insurance. In that instance, the debt service is covered by the income, so you'd meet the ratio requirements to qualify. So this is a great program for self-employed clients who maybe don't show a lot of income on paper, or anyone else that just can't verify their income via the conventional means. Another advantage is down payment. We can get away with 15% down payment on this option in many cases, including with multi-unit properties. So instead of the 25% down payment that a conventional loan requires, 15% is a lot less, especially here in California. Based on our purchase prices, that's a huge amount of cash and gives the investor a lot more leverage with their capital. So rates are going to be slightly higher than conventional loans, but still really competitive and popular with investors, especially those that are scaling a rental portfolio. The next option, let's talk about fix and flip or bridge financing. So this is going to be used for renovation projects or distressed properties. And unlike conventional or DSCR loans, where the property can be damaged or even unfinished. So with a DSCR, conventional loan has to be in good condition, livable condition. I've done hoarder houses, foreclosures that have been neglected and damaged, homes that are just completely unlivable. And
We already talked about this.
Oh,
Well, we left it.
we need to mute.
Sorry about that, Tom. Go ahead. But now you're on mute as well. Tom, you're on mute, I believe.
There we go. Can everyone hear me okay?
Yes, we can.
All right. So the idea on this type of financing is the investor is going to acquire the property and improve it, then sell or refinance. So they're looking for a short-term exit. Some of you may have heard of the BRRRR strategy, which stands for buy, rehab, rent, refinance, which often with cash out, repeat. This type of financing is perfect for that strategy. So the qualifying, instead of being based on your income or even your personal credit in many cases, is based on the property's potential and your exit strategy. So the lender oftentimes is looking at what we call the ARV, which is the after renovation value, to help qualify. So they're looking at the potential and the outcome of this deal. So simply put, this is short-term financing with higher rates, but it can help you finance the renovations on top of everything else. So it allows you to get more leverage with your capital, and then looking for a short-term exit, whether that's selling the property or whether that's refinancing into long-term financing like the DSCR or the conventional. And then last but not least, we've got private or hard money. A lot of people have heard of hard money, but don't necessarily know what it is. It's similar to the fix and flip or bridge financing, but usually through a much smaller or private lender. And it's going to be used when speed or flexibility is the absolute priority, especially when you're competing with cash offers. So it's great for unique or complex deals, or if the investor has major challenges with qualifying due to credit or income and other means. So the trade-off is typically the down payment is going to be much larger. 30 to 40% is common. 20% is a possibility with strong deals, but again, it depends on the potential of the property and the deal itself. So the trade-off is going to be speed, ease of qualifying versus cost. So which is why you often find experienced investors are the ones using this. It's going to make your margin for error much smaller due to that high cost of capital, but certainly not limited to experienced investors only. Next slide, please. So let's talk about how investors actually get started. So the reality is many investors start in a real simple way. They buy a home to live in first, and then when they're later ready to upgrade, they'll convert that first home into a rental instead of selling it. So this is a real common path because it's simple and practical. But the common dilemma we run into is a lot of people need the equity in that first home that they built up as a down payment in the next home. And so a lot of times people will sell the home to do that. But in our case, we can look at other ways such as cash out refinance or home equity financing to pull out that equity to help put down on the next home. So that first home often becomes the foundation of someone's investment portfolio. So the biggest mistake that I see new investors or home buyers in general make is they start looking at properties or deals before they understand their financing. Next slide, please, Shana. So the smartest step that I can recommend is that you get clarity on your financing options and your buying power. How much will a lender actually give you? Especially for investments, the numbers are everything, and financing makes up a large portion of that. So getting that some clarity on that up front will make it easier to recognize good deals when you have them in front of you. So if you're thinking about investing or you have questions, I invite you to schedule a free consultation anytime. If you want to scan the QR code that's on the screen, you can save my contact information, reach out anytime with any questions, and I'd be happy to help. Thanks for your time, everybody. Hope that was helpful, and enjoy the rest of the webinar.
Thanks, Tom. I actually have one quick question for you.
Yeah.
How are current interest rates impacting investment strategy right now?
Yeah, so rates have been coming down over the past year. They're about 0.5% lower than where they were this time last year. Still elevated historically, where we were, the past 10 years. So it definitely impacts the cash flow of properties. But that's temporary. Rates are expected to continue to improve. So what I find are investors are still looking for the good deals, especially since prices, at least in our market here in Southern California, are expected to continue to rise. So the sooner they can get in, lock in that price, they can always refinance later on.
Okay, makes sense. So, all right, capital allows acquisition, but smart investors also think about tax efficiency. So, with that, I'd like to introduce Stephanie Kelsey. She's a qualified intermediary and a 1031 exchange accommodator who has facilitated hundreds of exchanges. Stephanie, when should investors begin thinking about doing a 1031 exchange?
Well, when they've had a property for a little while and it's, got a good amount of equity in it, it's appreciated, there's not a lot of debt. It's a good time to think about doing a 1031 exchange and expanding your real estate portfolio either by asset class, geography, getting a larger property, or getting multiple properties.
Good to know. Well, I'm sure we've got a fair amount of people wondering what in the world is 1031 tax exchange and how do I use it? Can you help us through that?
Absolutely. So it's going to be a lot of information. So I'm going to go a little fast, but I want to make sure you guys understand the basics. So, first off, basically, a 1031 exchange, we need to realize, is a tax code. So, we want to always make sure we understand who the taxpayer entity is for that. What the 1031 exchange tax code allows investors to sell investment real estate and reinvest in like kind investment property. What like kind means is any real property held for productive use in a trade, business, or for investment purposes. So you can go from raw land, multifamily, single family, retail net lease, industrial. All of those qualify as like kind real property. So if you start with a single family, you don't have to stay with single family. You can always diversify your portfolio by different asset type. So what we're doing here is the 1031 exchange allows the investors to defer their capital gains taxes. So it doesn't eliminate them, but it defers them. However, if they have good estate planners and they set everything up correctly, we're hoping that when the heirs inherit the properties, they're supposed to get a step up in basis, which does actually effectively eliminate all those capital gains. And then the heirs should get to start over with a fresh slate, whatever the property was worth in value the day that the inheritance started moving forward. They want to do this to take that equity and continue moving it forward into future purchases to expand their real estate portfolios. So the capital gains taxes, there's 4 different layers of them and they add up kind of quick. So the first one, there's a 25% depreciation recapture, 15 to 20% federal, a 3.8% net investment income tax, and then whatever your state tax is. For California, it can be as high as 14.4%. So when those are all added together, the capital gains that you would be paying are going to be somewhere between usually 30 to 37%, depending on the state tax. Okay, next slide. So we want to make sure that we understand there's a lot of rules that go along with 1031 exchange. So the deadlines are set. They're in stone unless there's some national disaster that allows them to be budged a little bit. But technically speaking, these deadlines, these timelines start at close of escrow. So when escrow closes on your sale, you have a 45-day identification period and you have 180 days to close on the property. So the first 45 of that 180 is your identification period. The identification must be done in writing, and it has to be submitted to the qualified intermediary by midnight of the 45th day. I do not recommend waiting until midnight of the 45th day, but whatever's on your list by that time, those are the only properties you can close on. So I suggest people start looking at properties aggressively the minute they go under contract, because that allows them an additional 30 to 45 days to find those properties to identify for their list. Get in there, get your properties, get your offers in, get your inspections done so that whatever's on your list, at least you've got one viable candidate on there that's going to close. So there's different rules as well regarding how you can identify. The first one that most people use is called the 3 property rule. Basically, you can identify up to 3 properties of any value and close on 1, 2, or all 3 of them. So you've got 1, maybe the other 2 are backups, or maybe you've got 2 and you've got 1 as a backup. Because again, that list cannot change after that 45th day. The second rule is called the 200% rule. So say you wish to identify more than 3 properties, that is allowable, but they're going to put a cap on that amount. So imagine you sold your property for $1 million. The most you can identify with all the properties combined would be $2 million. So twice the amount you sold your property for. Now, if you want to identify more than 3 and have any value for each one of them, you can do that, but this is a lot more dangerous. The 95% rule, whatever you identify, you must close on 95% of those properties. So you pretty much have to be positive you're going to close on everything. Because if you don't close on something and it's not 95%, you've blown your whole exchange and you will be subject to capital gains taxes like you were before. Okay, next slide. Okay, so the numbers moved a little bit. So we're going to put a scenario together. There's a married couple. They purchased a property 30 years ago for $400,000. It's currently worth $1 million. They sell it for $1 million. So they're going to be paying those capital gains taxes. They're just doing a sale, right? So 348,000 of that would be, I'm sorry. So the 400,000 was the purchase price. This property has been fully depreciated, which means that their new tax basis is $100,000, which puts their capital gains at 900,000. So we're going to apply all 4 of those stages of taxes that I mentioned earlier: depreciation, federal, state, and net investment income tax, which is going to be about 35%. So they will be paying 348,000 of that $1 million for their capital gains taxes. Now, if they decide to do a 1031 exchange, they can then keep that $1 million, redeploy it into new property. So what that looks like, we're going to imagine that they're going to leverage up 75%. And so the most they would be able to purchase if they just sold the property straight out would be $2.6 million. So after the taxes, they had $651 million left over. If they did the 1031 exchange and deferred those taxes, they have the purchasing power of up to $4 million, which is going to allow them a lot more flexibility and hopefully a better return on their investment. I don't know why that slide got jumbled. It looked fine earlier. Okay. What does full tax deferral look like? So for full tax deferral, you need to reinvest all the net proceeds and then acquire a property with the same or greater debt. So that debt needs to be replaced with new debt or with cash out of pocket. So here's a scenario for full tax deferral. They sold their property for $900,000 and they're going to be purchasing for 1.2. They have debt of $300,000 and then the cost of sale, which is closing costs and commissions, that amount does not need to be reinvested. So their net proceeds, the cash that they're going to get from that sale, is going to be $540,000. They are going to reinvest that. They're going to increase their debt and purchase that $1.2 million property. The boot is the amount that's referred to as subject to capital gains taxes. So they have no mortgage boot and they have no cash boot. So this is a fully deferred 1031 exchange. Next slide. So can we do a partial exchange? We actually can. Yes. So you're going to sell your property for $900,000. You're going to be purchasing for $700,000. The debt was the same. The cost of the sale does not need to be reinvested. Leaves you with $540,000 to reinvest. They chose to keep $100,000 of it out. That's $100,000 cash boot. And they did not replace all of the debt with new debt. So there's $40,000 of debt. So that's $40,000 worth of mortgage boot. Total $140,000 of boot that is subject to capital gains taxes. Next slide. Okay, so that was it. A little quick, a lot of information. My QR code is in the corner. Please feel free to get my contact information if you'd like to learn more. I'm happy to get on a call with you, go over the whole process. There are a lot more nuances to the 1031 exchange. There's reverse exchanges, improvement exchanges, leasehold improvement exchanges. There's vacation homes, all different types of things that do qualify. We handle all of those exchanges. Let's go over some of the pitfalls. So not setting up the exchange prior to close of escrow, missing the 45th day identification deadline, because that's not movable, receiving the sale proceeds. In a 1031 exchange, you're not able to have constructive or actual receipt of the funds. So it is absolutely mandated that the exchange be set up prior to close of escrow. Because if escrow closes, then you have constructive receipt, even if you haven't received the funds yet. So if it's even the last day, you can call me at the last minute and say, I do a 1031 exchange, but I'm supposed to close today. It can happen. Just make sure you haven't recorded yet. Call escrow, have them pull it, have them wait. We'll get it done quickly, but I prefer you calling me the minute you go under escrow so we can get everything set up at the beginning. And again, as I said at the beginning, 1031 exchange is a tax code, so it applies to the taxpayer. So we always want to make sure we've identified the correct taxpayer entity. Is it the individual doing the exchange? Is it an LLC doing the exchange? Is it a trust doing the exchange? If it's a living revocable trust, then it's usually the individual. Sometimes LLCs are just there for liability purposes. So the individual is technically the taxpayer, but the LLC is also included in the whole process. Sometimes people are a multi-member LLC and then the LLC together is doing the exchange. So I can help you suss all those things out to make sure that everything runs smoothly and that you're compliant and that you get through your 1031 exchange and take care of all the deadlines and reporting. So thank you so much, Shana, for having me on today. And thank you to everybody who's come to learn a little bit more about investment real estate. These are all important things that are really going to help you if this is the path you're moving down.
Thank you, Stephanie. So I've got one question for you.
Okay.
Can 1031 exchanges be used strategically for portfolio growth?
Absolutely. And that's one of the main things that they're capable of doing. So when you're redeploying all of those capital gains that you're not having to pay to the government, like you just saw in that last scenario, they have an extra $350,000 that they can put into replacement property. So that's the best way to do it. It's good for estate planning. Say they've got one property and 3 children. They've had it a long time. There's a lot of equity, low debt. Sell it, buy 3 properties. You're going to also increase your return on investment. So usually every 5 to 10 years is a good time for people to start considering, depending on what the appreciation is on the property. If it's got a lot of appreciation, you might want to leverage that up and purchase a few properties, increase your investment, return on investment.
Makes sense. Okay, thank you. So once you acquire and structure properly, protection becomes critical, right? And I think what comes to me organically is next is protection is one layer. We've got performance coming later, but let's talk about protection. With that, I want to introduce Ramona Smart. She specializes in property and casualty insurance for homeowners and investors. Ramona, what are the most common concerns you hear from investors when it comes to ensuring they have the right coverage for their properties?
As Scott has stressed, I think liability, I think that is one of the biggest things that people are concerned about is what they are putting at risk when they are making such a huge investment and it's an asset and then not having the proper coverage, then they are putting all of that hard work on the line. So I think the insurance is a huge preventative measure and mitigator for putting all of those assets at risk. I have, if you can move ahead on the slide. One more.
Did you want to start with?
You're
Do you
cutting
want to
out.
start
No
with
worries.
acquisition?
No. I if you want to go ahead, that's fine. But essentially, you're cutting out, sweetie. I'm sorry.
Got it. Pardon me.
Okay.
Let me hide my
There we go.
video.
No,
See if that does.
you're fine. So I have been in insurance for about 13 years, And I have a vast experience with different levels of investors. You can start from just the flipper, the person who is, I have a client that they buy a property once a year. They flip that property, sell it, and move to the next one. I have another client that he goes around and buys lots. He sits on those lots until he finds somebody like a Starbucks that wants to build from the ground up, and he then has that property that he leases to them while they're doing the building, and then he sells the property to another investor later on down the line, or he keeps in his portfolio. I also have another investor that he is actually a property manager and a builder. And so he will come to me when he has built a 63 unit apartment building or a condo, and he needs to now have coverage during the time period when he is selling each one of those condos, and we build out his HOA. So there's this wide range of client that I work with in order to secure the proper coverage, and every need is different and there's different phases. So I wanted today to take you through the different phases of an acquisition, because you can pop in at either one of these phases. But just from the ground up, we'll start with phase one. You're out there and you want to start with just a vacant piece of property or a vacant building. And that is the time period of acquisition. Normally, in that time period, you don't have your permits yet, you don't have your building plans, but you have gone through the financing and now you own this property. There is liability risk there still because you have a vacant land that you own and you are now responsible for. I always encourage my clients to make sure that that is fenced and that we have a vacant policy on that, which is a liability coverage. And God forbid somebody were to come onto the premises and injure themselves. Yes, they would be trespassing, but at the same time, I have seen where trespassers say that they fell on your property and they now are suing you. So that is always a good stop point if you have a vacant property and you're still working on getting the permits and the building. And sometimes that can take a year, it could take 6 months, but we want to get that policy in place. And oftentimes these policies are, you can do them for 3 months at a time, 6 months, or 12 months. So you have that flexibility, and it's just being able to time that out. If you want to go to the next slide. Pretty please. Okay, next is the renovation. So you have the permits, you have the building plans. Now you want to start building. So now this is, as Scott said, you want to get a good contractor. You want to make sure you have your general contractor that has their insurance in place and their workers' comp in place. You are insuring yourself as the owner, and you're also insuring the building. So if there's a current structure on there, you don't want to say you bought the building for 500,000 and the building value is 500,000. You're going to put another 500,000 on there. But in that process, you don't want to risk the structure that is currently in place while you're adding to it. So you want to have that vacant building insured. And that is in the builder's risk policy. So it's the current structure plus the additional as you're putting on. Imagine you are 200,000 into the build, and there's a fire, and you've risked now 700,000. So it covers you through all of those phases. There's hard costs, which are the actually building and materials that you are putting on this property. And then there's soft costs, God forbid that there was a fire and you had to start over and you have to go through getting the permits again, all of that. So those are the soft costs. One item that people tend to forget is the theft of building materials. That happens often. You have purchased a air conditioning system. It's been delivered to the property. It has not been installed yet. If it is not installed, it's not a part of the building. If it is sitting in the yard, now this is building materials that are at risk for theft. And if you don't have that building theft coverage, there's no coverage for that because it's not a part of the building. So you want to make sure that you have that coverage when you're looking at a builder's risk policy. Go ahead to the next slide, please. So the building is done. A little known fact is that once you have the certificate of occupancy, that builder's risk policy is done. So this is often a gap. So you have built this home, you have gotten your certificate, everything's done, you are clear to now put it on the market. You have someone coming in to stage. The policy that you have already purchased and have been in for maybe a year is no longer valid. So they still have 3 months for the policy to expire, but it's not valid because now you have a certificate of occupancy and it's no longer a builder's risk. So what you want to do is make sure that we then put you back into vacant policy for the estimated time period that you believe it will take you to stage and then sell. So that is a big gap that I often see people take a gamble with, where they're just like, you know what, I have this policy in place. I'm just going to let it ride. And that can burn you at times. So I definitely suggest that each one of these phases, you are in the proper policy at the right time. This is a gap that often exists. If you want to go ahead and go to the next one. Now, this is, you now have your asset and it is ready to be occupied. So you've decided not to sell and you decided to rent it out. This is the landlord policy. This ensures you as an actual landlord, so all the liabilities that may exist with that. It also helps you with loss of income. If there was a fire and you could not rent that place out for 6 months during the covered claim, you would want to have that rental income still coming in. So that covers you for that. Property damage, which is the building, but something that people often forget is that you still want like the actual a little bit of coverage for property, which is if you own the washer and dryer, if you own the refrigerator, just to have a little bit of property coverage is always good. In this phase, you want to make sure that your tenant has renter's insurance, because that's going to help you as well protect them and protect yourself. Where if they destroy your property, you can now file a claim on their policy because they have, through negligence, damaged your property. So that's always something big. Tenants often think that you are responsible to cover their hotel bill or their displacement if there was a fire. That is not your responsibility. That is what their renter's insurance is for. The tenant, often your landlord policy has a disclosure that you require the renters to have renters coverage because they are now inviting guests into their home. And if they were to slip and fall and sue the tenant, you're likely going to be named as well. So you always want to make sure that that first line of defense is their renter's policy. And hopefully that will take care of that. I think that's the biggest deal, is making sure that you are also named as additional insured on their policy, which is a big deal because that will help the liability extend to you. And next slide. Here's a summary of all the different phases. So we have the acquisition, which a policy would be for the vacant property. The renovation, that's your builder's risk. Once the policy is completed, you're going to do either another vacant bridge or you're going to move that into some sort of landlord policy if you have someone that's going to move in once it's ready to occupy. My QR code is on the bottom. I have a vast array of experience in this field. It is one of my favorite things to do, and just watching people go through these phases and having successes when they sell and they move on to the next property is always a great relationship that I like to maintain. I can do an assessment of your policy if you like. If you're in something that you're not sure is properly taking care of you, you guys can email that to me, send it to me, and we can just walk through each of the coverages and make sure that you are covered properly. It was lovely to be here, and I appreciate your guys' attention.
Thank you so much, Ramona. All right, so again, we have protection as one layer, but performance is an entirely different factor. So I'd like to move to Tracy Dugan. Tracy Dugan brings more than 20 years of experience across real estate owned, luxury, commercial, and portfolio management. Tracy, what operational realities surprise you today? Well, that's assuming we have Tracy on. Let's see. Maybe we will come back to Tracy, actually.
I'm here.
Oh.
So technical difficulties, everybody. Can everybody see me?
Welcome. We can. You look fabulous.
Thank you so much. Okay, so I am going to, let me make sure. Can you still continue to see me?
Yes.
Okay, great. So thank you so much for having me, Shana. It's really a pleasure to be here. I'm really excited about it. I've learned quite a few things. As Mona was talking, I was reminded of, I've been doing business with Mona for probably 15 years now. I was reminded of a property that I did not think could get insurance coverage because it was a hot mess, big time. My buyer was a builder contractor, and he did get a hard money loan, and Mona was able to get us covered. He was able to rehab the property in less than 6 months, and then he was able to obtain a more viable coverage. So Mona's great to work with. With regard to property management, good management determines whether a property performs or becomes stressful. And that really does start with placing the tenant and making sure that we have a very viable, well-qualified tenant in place, and not being in a rush to just place somebody in the property to hopefully get rents and keeping our fingers crossed. Most of the time, owners who are having problems, they call me because they've done exactly that. And now they want me to some kind of way very quickly unwind that problem. And it's not something that can easily be unwound. So first, that starts with we have to check credit. We also check the income viability and make sure that the tenant has the adequate income. And then also we check with past landlords to make sure that we are in fact inheriting a good tenant with a good background. We do normally establish certain guidelines for this. It's different for different properties. For instance, if we have a multi-unit property or multi-unit tenant, our criteria might be just slightly lower than if we're renting out a single family residence or a luxury property. Generally speaking, 650 or above credit score with no derogatories or no recent derogatories, income at usually 3 times the rent or more, hopefully, and a good reference from their landlord, and even the landlord prior to that is really what we're looking for. Then once we've placed our tenant, we want to first, before we've placed the tenant, we want to have done our due diligence to make sure we've done all the preventative maintenance. And then obviously we want to inspect the property when the tenant first moves in, and then do inspections periodically, at least once a year, depending on the property and what's going on with the property, and making sure that we, keep the property in good working order. Also making sure that we just upkeep everything. So, keeping the trees trimmed, keeping the bushes trimmed back, making sure we have proper lighting in stairwells, making sure there are no trip risks in the stairwells and things like that to maintain the property. And then ultimately, when we have a good tenant, we really want to make our repairs timely and assess the types of repairs quickly. Normally, you want to respond to a tenant when they reach out. Most of our tenants send an email. If it's not urgent, if it's urgent, then we have like a 24-hour phone number that they can call, and we do respond to that within 24 hours, usually sooner. And then we want to time said repairs. So for instance, if the tenant says, I don't have any hot water, I have to respond to that very, very quickly, again, usually within that 24-hour time period, if possible, and get a plumber over there to either, fix the hot water tank or replace the hot water tank. I really don't have the time to, shop for a less pricey hot water tank. I have to get the tenant whole as soon as possible, because having hot water in a property is a habitability issue. And we need to pay specific attention to habitability issues. If the tenant calls me and they say the lock on the bathroom door is not working, that's a little bit different in terms of timing, response time, than, let's say, a hot water heater. Okay, next slide. What drives profitability? Well, 2 points. Pricing, definitely. Making sure that we're not overpricing the property and we're not underpricing the property. Overpricing the property means that it will most likely be on the market longer. And oftentimes, once we get to fair market value, in terms of, if we reduce the price after a month or so and we get to fair market value, oftentimes tenants now know that it's an aged asset and they will ask for a discount. So we really don't want to overprice it. And we also don't want to underprice it, because a couple of reasons. First of all, unlike in the sales market, underpricing a rental property does not cause, does not cause a bidding war. Most of the time, if the property is underpriced, let's say we price it at $3,000 and we really comped it out at $3,500, those tenants are not going to offer, $3,200, $3,300 to get in the property, even though there are a lot of people interested in the property. So we don't want to do that. And then also we have to be mindful of rent control. In a lot of communities, I work in Los Angeles, and here in Los Angeles, we have pretty stringent rent control guidelines. So if we underprice, let's say it's a multi-family property and it comes under the LA City guidelines and we've underpriced that property, then we can only raise the rent a nominal amount next year. And now we're below the market. Normally on a multi-unit property in Los Angeles that comes under the city of Los Angeles rent control, you can only raise the rent 3% to 4%, depending on the year. So we don't want to underprice the property, because we'll constantly be changing the market. That's something that's not really something that we want to do. Rent increases. Normally, we do rent increases at least one time a year. For multi-unit properties, that is what's allowed. For single-family residences, you can do it a little bit more often, depending on what type of lease the tenant is in, but I do not recommend that. But I do recommend that we always raise those rents for a variety of reasons. One, it's just a good marketing strategy to do. But secondly, if your ultimate goal is to get the rents up over the course of, let's say, 5 years, and then you want to sell the property, the property is really much more viable if the rents are at market rate. And then finally, assessing opportunities for additional income. So that could be something like installing a coin washer and dryer in the property that will increase our income. It may also include, if we have the room for it, installing storage, not facilities, but storage units on the property that we can rent out for a certain amount of money. Most multi-unit properties, the tenants usually require more storage than what they really have. The other thing could be adding garages if we have space on the property. And then finally, this is a big one because it's costly, but it can really bring up the value of the property, the value of the asset, if your long-term goal is to either make it cash flow sooner, or you want to sell the property in the next several years. And that is to add an ADU. ADU is short for accessory dwelling unit. And so for single family residences, now you can, if you add an ADU on there, now you have another rental property. If you have enough room on a multi-unit property, let's say there's an area in the back of the property, or there's an area of the garage, or the garages can be converted, that sort of thing. Those units can become very viable because now they're not subject to the rent control guidelines that the other portion of the property is subject to. Next slide. Responsibilities of the owner. So one of the conversations that I have with my new owners, and this is normally my mom and pop owner, who maybe they have owned this property for a significant amount of time. Now they want to rent it out, and they're going to move, or they've bought another property, is making them aware of capital improvements. They've lived on the property for 30 years, so the way they live on the property may be different than the way the tenant lives on the property. So they may be shocked to find out that, now we have to put a roof on the property, or now we have to completely replumb the property, or we may need to add something to the property that we did not anticipate. And being in a position as an owner to rally and to do that, if need be, is very, very important. I have this conversation with owners all the time because, they're looking at the income that they can acquire monthly on this, and maybe they're going to use the income in some capacity, but they're not really looking at the possibility for repairs or even capital improvements. The next one is compliance with the laws. So I have to say that the laws since 2019 have changed really quickly, and I'm really surprised by how every time I turn around, every couple of months, there's some new law on the books that we need to comply with. And that is my job, to do that. But I also have to make the owners aware that, yes, even though you may have lived on the property and you want to visit the property to work on the yard or what have you, we have to comply with the laws. We have to notify the tenant that you're going to be on the property. Or I had a new one that came up just recently this year. I rented out my mother-in-law's townhome in Orange County. She did do a lot of work to upgrade it. It looks beautiful now, but and she spent about $35,000 to do the upgrades, which is great because we're able to increase our rent quite a bit. However, as of January 1st, there's a new law that requires that owners get a refrigerator. So I just informed her literally yesterday that now she's going to have to provide a refrigerator because all rental units now are required to have a refrigerator. Allowing the management process to work. So that really is a nice way of saying, let me do my job, and you stay in your lane, I'm going to stay in my lane. Because I know that you may have you have your own handyman that's worked on the property for 30 years, all 30 years that you've lived there. We don't want to hire your handyman. We want to hire a licensed vendor to handle our repairs correctly to prevent liability. So, that's something that I always request owners not to do. Next slide. Oh, key takeaways. So the performance of a rental property is determined less by the day you buy it and more by how it is operated afterwards, or that's very true. So you may have bought the property and for a certain amount, but in order for the property to remain viable or to become a cash producing asset, or a property that you maybe a couple of years from now can take and sell for quite a high value, we have to maintain the integrity of the property and upgrade it on a regular basis to the extent that we need to, so that it's a viable asset for you in the event you decide to sell the property. Okay, and that is the end. You can certainly reach out to me at any time if you have any questions. I'm available to take your phone calls or your emails or whatever you need from me to help you purchase your first asset or to help me with the assets that you have right now. I don't suggest that owners manage their own properties anymore. There's just so many laws here in California. It's really hard for you to be aware of what the new laws are and what the new requirements are. So it's in your best interest to obtain management.
Thank you, Tracy.
Thank you.
And finally, how does this all fit into long-term planning, Otis?
Great question. Before we jump into that, I just want to say what a powerful panel to be on this evening. And Shana, we gotta shout you out and just appreciate you for putting this together. I believe there's tons of value that's being relayed tonight. So your question was, how would someone think about this with integrating into their real estate into their overall financial plan? Well, first I'll say real estate is not just an asset. It's actually a wealth accelerator. I want you to think of it as a house inside of your financial house. So what it does is that it generates cash flow, it builds equity, it gives you some tax superpowers, but never let it be the full foundation. So the question is, you should really start by asking, does this property move me closer to my goals, to my freedom, to my retirement, whether that's through, legacy building or whatever we're going to talk about. But the important thing is to understand that it's just something that is a part of the pie, right? So if I can get my slides pulled up, we can get this thing going. So you guys should know I've been doing this for the last 11 years. I don't like what I do. I love what I do. So if you hear the energy and you hear the passion, that's just because I'm obsessed with helping people. So what I want to do tonight, just kind of tell you guys a quick story about a lot of what we've been hearing and just kind of turn it into something. So by a show of hands, or maybe you want to put a 1 in the chat, I don't know what we do here, but how many of you are in the accumulation stage of life where you're working hard every day, you're growing your retirement accounts, your real estate specifically, savings, and then you're just dreaming of that day when your portfolio finally hits a big number like 4 million. So tonight, I want to tell you this story that's up here on this screen, a true story actually, of a client. His name is Alex. He's a regular person just like you and I, right, who actually reached that $4 million mountain. And after 20 years of just buying rentals and investing, but the problem with him making it to this mountain of 4 million is that without the long-term plan, Alex is still at risk of losing a lot of what he built. So I want to talk about this story together. So I want to put some scenario to Alex, because Alex in this scenario is 55 years old. 55, okay? A lot of us, I'm not close to that age yet, but 55, okay? So Alex has been building something, he's been growing something. He's not a Wall Street guy. He's somebody like you and I. He's a teacher, he's a contractor. He's a small business owner like a lot of us. And over this last 20 years, he bought rental houses. He fixed them up. And now that's amounted to 4 million in real estate equity, plus some cash and other things. So on paper, to a lot of us right now, 4 million is like, oh my goodness. Or maybe you're like, okay, Alex is set. But everything that Alex has right now on paper, it's in different silos. So Alex has real estate over here. He has a 401k over here. There's some savings. Problem is that Alex does not have a coordinated plan. So I want to double click in on this situation, because in the accumulation stage that we're all in, it's easy to focus on the next deal or the next contribution and forget to ask, what happens when life throws us a big bill repair? Or if you have real estate, a vacancy, and when it's time to pass it on? Without a plan in place, the growth of these plans, they stall, okay? Because taxes can sneak up, and then your family that you've been building this thing for is ended up in a place where they're forced to sell your legacy that you've been creating. So I want to ask you right now, what plan do you have in place? And when it comes to everything that the panel's been talking about, I feel like everybody has such a unique spot in this evening's conversation. that if you can take all of this and put this into a plan, here's what's going to happen. On this next slide, here's what I want to explain to you, how real estate is going to fit into a complete wealth strategy. So real estate is an amazing wealth engine. Like a lot of us, I own real estate. I know a lot of us, I see some familiar names on here. They do as well. But real estate is a wealth engine. It appreciates. There's rent checks, there's leverage, and you're all out making that happen every day. But in the accumulation phase, it's also going to tie up your cash. So one roof, one bad tenant, you sprung a leak on something, you got to replace a water heater, and then suddenly, most people, they find themselves in this state of scrambling for liquidity. So here's some common traps that we fall into as we're climbing right now. So number one is that we over-concentrate in real estate because it just feels safe or feels familiar. I remember first time buying real estate for myself, it was because my uncle told me to do it. And there wasn't a plan that was attached on the back end. The second thing is raiding retirement accounts just to buy that next property. So as a financial professional, what is not warned in planning is that your favorite uncle, Uncle Sam, you will be in a triggered state of taxes and penalties that you probably didn't budget for. And then the last thing is that skipping life insurance or estate planning, because people just say, oh, I'll just deal with that later. So these are the exact mistakes that people in my industry that I come across and I watch make on a day-to-day basis. And what they do is that they quietly steal years of growth and security from our families. So on this next slide, I'm going to get a little heavy on the numbers here. And I want to fast forward Alex to 25 years into the future. Okay. So what you should see here is this graph. There's no coordinated strategy. All Alex did was that he just kept buying. He kept contributing to that account, and then he hoped for the best. So in this top example, what you see is that at his account, it grew to $10.7 million. And that $10.7 million was just all of his assets accumulating at just 4% over time. Okay, so that's a big number to a lot of us, but what if it could have been a lot more? So with a simple plan that layers in the right pieces, basically taking all of those loose puzzle pieces, putting them together, during that accumulation phase, this same portfolio can reach 17% with just a conservative 6% growth. So right now, I may be talking just some numbers to you that just sounds like, oh, that may not be me. But if you're on this call, that means that you're here because you want to grow. That means that you have a wherewithal on how money works. And financial literacy is something that you crave. So that extra growth, what we're talking about, it doesn't come from luck. It just comes from connecting all of these real estate pieces together. So on this second to last slide, I want to help you guys understand that there's a hidden danger that most of us in the accumulation stage, we never think about till it's too late. So Alex's portfolio is projected to keep growing. Maybe it's, 18 million. But in right now, 2026, the federal estate exemption, it dropped to about $15 million. So that means that anything above that can be taxed in an additional 40%. So that's potentially $1.2 million that's due, by the way, Uncle Sam wants within 9 months of death. So the real pitfall is that real estate, it doesn't mail checks. So the kids or the spouse, the very family that we've been accumulating, we've learned what we needed to build this mountain for. What we have to do is that we have to be in this position where we have to sell properties. And then at worst, possibly we have to pay the tax on that. So if you don't have a plan, then you plan to fail. But the great news about this conversation tonight, is that on this last slide, is that you don't have to be at the top of the mountain yet to fix this. These same tools that protect people like me, protect people like you, they also can supercharge your accumulation years. So what I want to break down simply is 4 tools that can help you. One is cash value life insurance. It's probably one of the most underlooked strategies when it comes to financial planning for long term. Number 2 is term insurance. Okay, again, very affordable to be able to help you with some pretty simple planning. Number 3 is annuities, because you can turn annuities, you can have that turn into a portion of your savings that provides you lifetime income stream. So you're never put in a position where you have to be forced to pay off Uncle Sam. These are tools that are in place that help out people. And then lastly, is just some basic estate planning. So, having things like a will or trust that are in place that makes the transfer of what you've created for your family seamlessly just help your situation. So in closing, Alex, the story that I'm talking about is realistically it's our story. So we're all right now, we're in the accumulation stage. Everybody right now is grinding. We're building something big for our families. Otherwise, it's 7:20 at night where I am. You probably wouldn't be here. The pitfall isn't failing to reach 4 million, ladies and gentlemen. It's reaching it without a coordinated plan and watching parts of it just slip away later. So I want you all to understand that right now in closing that you need to start the conversation right now. You got to get your own portfolio with your clients. You got to help them climb, that mountain. Spread the word about what Shana is trying to connect right now, because when you begin to connect the dots, the way we're just talking about tonight, you don't just build wealth, you protect it for the people you love the most. And that's how you turn a good story into a great legacy. Shana, back to you.
Thank you, Otis. That's exactly where I'm headed. I know it's about 7:21, got about 9 minutes, and we still need to do some live Q&A. So I'm going to try and in the next few minutes pull all of everything you've heard today from our attorney, our tax strategist, our property manager, Tom, our mortgage lender, and really piggyback on a lot of what Otis was talking about now. And the idea is, let's think about real estate as a whole, not just as a property, but as a strategy. So with that comes the question, what is rich? Now, usually I like to take a moment and actually inquire with the rest of the audience on what this means to them. But in the interest of time, I'm going to throw a little volley on this, right? Rich to me is the ability to wake up in the morning with the physical health, knowledge, friends, and financial freedom to do what you want that day. By way of that, we get financial independence, but only when our investment income exceeds our living expenses, which is key. So what are the two ways to earn income? Well, we have active income, right? That utilizes your time. So think your job, think your effort. If you're an employee, for example, I'm not sure if anyone's familiar with the book written by Robert Kiyosaki, Rich Dad, Poor Dad, but he has a cash flow quadrant, and one of them is I'm an employee, I work hard for someone else, and if they turn that spigot off, I am at the mercy of them and them potentially turning my world upside down. Then you also have someone who may be self-employed. So they work hard for themselves, but they are throttled by the time, as much time as they can give because there's only 24 hours in a day. So both of those people, employee and the self-employed, can actually transition into two other categories, which is a business owner, where you have people working hard for you, and investor, where money is working hard for you. And everyone on this call today can fit into that category. So when you have investment income, you can leverage your assets. And so most people earn income with their time. That's where they start. But investors start focusing on building income from their assets. So why choose real estate? Well, cash flow, right? Income from rent. It basically keeps working well after you stop. And I like to call it freedom money, right? It's the way, it's the vehicle to get you to the next steps. You've got appreciation, at least in California. Over the last 30 years, you've had home values that have appreciated I should say quadrupled in the last 30 years. It's huge, right? It's meaningful. Leverage. You can control more with less capital. We had Tom earlier today help us figure out how we can leverage capital to create short-term goals, which is by way of acquisition and the money to get there. But also those short-term goals will lead into our long-term goals, which is free and clear properties, where you get to live off the appreciation, as well as the revenue if you choose to rent it. Next, we have loan pay down. I don't know any other area. I haven't found it yet. So if you do know, please let me know, where you can get a loan and somebody else gets to pay your debt down. It's powerful. It's magical. Tax advantages. So we had Stephanie Kelsey, our 1031 exchange, highlight earlier that there's also meaningful tax advantages, especially when you understand strategies like 1031 exchange. So humor me for a second. Let's just cast a vision. What if you did what we're about to explain right now? Let's say you purchased 10 houses. Average price point is $300,000 each. 15 years ago, financed them on a 15-year loan. Today, your houses are free and clear. Congratulations. They're probably worth $650,000 to $700,000 each. Your houses are probably earning at least a gross income of about $350,000 per year. And this is just freedom money. This is just on top of if you're still utilizing active income, right, from your day job. That would yield you a portfolio net worth of $7 million. Who could use that? I know I can, by the way. $7 million. It's life-changing, especially when you didn't work for it. Someone else did the working for it for you. But let's also use a real example. This one is fresh. It's hot off the press. This is a transaction I closed last Thursday. It was a seller that I was representing. They purchased this house in Santa Ana. I know some people are scared of Santa Ana, but it's actually a beautiful town, especially in West Floral Park. They have multi-million-dollar homes in this area. They purchased it for $200,000 23 years ago. They lived in it for 3 years. They rented it for 20. Now, they decided to not necessarily check on the property as often as they should. And so we had a significant amount of deferred maintenance. Needless to say, they were ready to sell. They were surprised by this distressed condition, but the seller did say, okay, so since I can't list it at market price, and we remained off market for this deal, but if I can't list it for the market rate, can I at least get 5 times what it's worth? And the good news is I actually found a buyer that came in all cash, non-contingent, fast close. And what it created was a win-win-win. You see, the sellers made 5 times their money while the tenants paid down their debt. By the time they sold this property, they only owed $50,000 on it. So they cleared $900,000, maybe a little bit less accounting for taxes, but that was just over the course of 23 years. The investor saw the diamond in the rough and realized it was worth the time, effort, money to either flip this house, because based on comps, he could make $500,000, or rent it and triple the rent. So I think at the end of the day, what we know is, listen, the best time to have invested in real estate was probably 20 years ago. The second best time is today, right now. Think about it. Same property, different lens. So that was what success looked like for them, right? But I want to ask you, what does success look like for you? How much freedom money do you want? How many houses will you need to buy and over what period of time? How much cash will this take, and where will you find it? We've got a financial planner here, right, that can probably take your 401k and convert it to a self-directed IRA. We've got Tom here, our mortgage broker, that can do a cash out refinance. Use your dormant equity in a house that's not doing anything other than building, and use that to create freedom money by putting that money to work, investing it somewhere else, and actually giving you more in the long run than what you can do by keeping it in your house today. So the key is, I've already done the work for you, formed the team, and I encourage you to leverage some of the resources that we have today. They're some of the finest on the market. Vetting is done. Give them a call, see how you can work your situation. But most importantly, when we think about how we should even set your amortization schedules on your loans, this is why you should call me. Let's work it out. What's your situation? What's your criteria? How much money do you want? We can walk through it, we can figure it out, and we can leverage the resources that we have today to nail it down. Now, if you choose to call me by clicking this QR code, you'll be pointed to my calendar and you can self-identify the times that work for you. But what I'll tell you is this will not be a pitch. There's no close. There's no sales fluff. It's literally just focused on you. How do we grow your dream of making money work for you? Next slide, really quick. 6 tips for creating freedom money. So what I do recommend is that you buy residential and multi-unit properties. So think duplex, triplex, fourplex. Airbnb is an option, but I have found that it requires a substantial amount of work. So while plausible, just get ready for all the demands of that. Believe in the long run. Again, at least in California, the market goes up, down, and all which ways, but traditionally and historically, real estate is always going up. My father, who was a big broker in his heyday in the 70s and 80s, always said you cannot buy real estate wrong. It's impossible. Take care of your property, so we'll take care of you. Tracy, our property manager, gave us some pretty good reasons on why we should do that. Get started early. Put time on your side. Appreciation compounds, right? Think about the Santa Ana example. 200,000, 23 years, selling it for $950. That could be you. It could be anyone on this call. Work with knowledgeable people. Once again, I think I've already underscored this. We've got talent here. Tap into it. They'd be happy to answer any questions you have today. Most importantly, have a goal, a plan. Let's talk about it. But most importantly, on top of that, know your enough number. So what I found was my father started off in real estate sales, became a broker, and eventually started doing hard money loans where he amassed an immense amount of properties. But he retired at 45 and he had about maybe 35, 40 properties at that time. And when I got older, I said, why did you stop? You were on a roll. You were winging it, doing well. And he said, Shana, I had enough. I had reached my number. And I think that's critical to know your number, because if not, you'll get lost in the rough of chasing and chasing and chasing and chasing and not really realizing how much time is going by. So know your enough number, and I can help you formulate that as well. I think from there, I invite you to chat with me. Let's talk about your current position. Let's explore what investing could look like for you. Let's build a strategy based on your goals. And let's have fun with it, right? We're not in a rush. It's 30 minutes. We'll talk through, we'll see what you want to do, and we'll see how we can help. With that, I am not going to take any more time. I want to open it up for Q&A. And I want to ask if there's anyone that has any questions. Actually, let me check the chat because I think we had a couple of questions already. Let's see here. We have a 1031 question, if I can remember that correctly.
Yes, there was.
Stephanie, do you remember it?
Yeah, one of them was asking me to go over the 95% rule again. So I'll do that one first because that was the shorter one. So the 95% rule indicates that you can identify more than 3 properties, and each of those properties can be of any value. However, you must close on 95% of whatever you identify. So that's where the scary part comes in, unless you know that you're going to basically close on everything you've identified.
Makes sense.
And then the other one was asking about DSTs. It said something about figuring out fair market value on the relinquished property. So the relinquished property is going to be sold like a regular property. You're just selling it. So whatever you get for it is the fair market value. When you go into a DST, which is an alternative investment vehicle that's completely passive for 1031 exchangers, basically there's, as short as I can say it, there's a sponsor entity who creates a real estate portfolio. You can buy into that portfolio as a fractional owner of all of the properties that are in the portfolio. It is a security, so you do need a securities rep to help you find those and navigate those. There are hundreds of them out there. Some perform well and some do not. So you need to make sure you have a strong representative to help you figure out which ones are going to perform as close to the sponsor's predictions. I used to be a sourcing broker for a DST, and I used to have my securities licenses. I've vetted a few reps if you need help with that. So some of the DSTs, they're like a stock, but you have to hold them for either 3 to 5 years or 5 to 7 years. And then on the other end, there's exit strategies that are built into the DSTs. The exit strategies can be multiples. There's 4 different opportunities. You can 721 into a REIT, which is a real estate investment trust, 1031 again to another DST, 1031 back into your own ownership, cash out and pay the capital gains taxes, or do whatever combination is allowable for that DST, because the sponsors create different exit strategies for each. Also for the DSTs, some of them have debt already built in. So if you have debt on your sale and you don't want to get your own debt, a DST might be a good option, because the DST's sponsors already have debt built in, and they are the ones that are carrying the loan. It is completely passive investment. You have no control over anything. And so that's kind of a really short thing. If you want to know more about DSTs, my company has a specialty department that deals with DST investors. I've got a 3.5-minute video that I can send you that explains them very detailed, and then you have that for your reference for later. So sorry, again, a lot of information.
Yes, no, thank you. And a big thanks to everyone who's staying on. We are happy to run through some of these questions. I know someone asked for the panelists, what was your first real estate investment, and what types of real estate investments are you currently holding or involved in? I know my first investment was actually in a house I inherited from my father, free and clear. And I just mentioned that because that was a wealth tool and power move that has paid itself forward 100 times over. So it started off with just me living in it. I did cash out, did some renovations on the house, enjoyed those renovations. And like Tom mentioned earlier, then I moved out and I did some Airbnb that was super lucrative, but also a part-time job. And then eventually I leveraged that to your more traditional renters. And when the rates were super low, I actually did a cash out refinance with Tom and leveraged that money and purchased a few other properties, and am still making more money than what that one property could make. And I say that only because for those who have children, it's a magnificent tool to build generational wealth. And I strongly encourage you guys to look into that for your own situation. I don't know if anyone else has anything they'd like to add. Okay, I think the panelist team is being shy. Well, do we want to move on to the next question? How does cash value life insurance play a factor with an estate plan? Anybody want to take that one?
I got you. So great. I'm not sure who asked that, but great question. You can always connect with me on any social media platform. I'm basically everywhere. If you guys need any more information, but cash value life insurance is an estate planning superstar in a lot of cases, and the reason why is because it passes your heirs a tax-free death benefit that skips probate entirely. So it's a really unique way to pass on money for real estate investors like a lot of us that are here or maybe inquiring about this. The cash value, it gives you tax-free loans also through liquidity. So there's no forced sale of rentals if you need to fork up a bill to Uncle Sam. So it's just pure legacy power.
And what are some creative ways to access cash for down payment needs. Tom, you want to take this one?
Sure. Retirement accounts are a very common strategy these days, whether it's a 401k loan. If you're a first-time home buyer, especially, you can make withdrawals and avoid the early penalties. Usually you're borrowing against other assets or liquidating other assets. If you don't have that luxury, gift funds from friends and family are very common these days, especially in Southern California where our prices are so high. Other than that, if you don't have a rich uncle, then better start saving. But usually it's borrowing against or liquidating existing assets, including real estate.
Awesome. Question for Otis. How can I use term or permanent policies to help protect my mortgage?
That's a really good question too. So term is it's just a cheap way to pay off your mortgage in the event of an untimely death. But term has to be within a certain period of time, hence the word term, fixed. So if you die, you get, your family's taken care of. It's kind of a risk in a lot of cases. But permanent, it just kind of like the last question, it builds forever, and you get to borrow money again against it, and it's a permanent form of protection. So you don't have to go into some fire sale if something were to occur during that. So term for budget and permanent if you want something a little bit more lifetime for longevity.
Thank you for that. What changes, policy, taxes, et cetera, do you see coming down the pike that will significantly impact real estate investing or your area of real estate investing? Scott, do you want to take that one? What changes do you see coming down the pike that will significantly impact real estate investing?
Well, we live in California, and California is always finding new and creative ways to mess with property owners, especially if you have tenants. So every day they seem to find new and creative ways to make your life miserable as a landlord. Having a management, I could not agree with Tracy more. Having a management company, staying up to date with the various local ordinances, the rent control, and that's also ties into before buying property. What I was saying before, make sure you're doing your due diligence, especially if it's tenant occupied. There is a statute which, as a landlord, you're buying a piece of property, you don't do your due diligence, and you find out that the two property owners prior to your purchase have been violating rent control for a decade. So you have to make sure that, again, you have a lawyer, you have a good experienced real estate agent who knows to ask the questions, get copies of all prior leases and what have you, because the law is constantly changing for landlord-tenant issues. So
Thank you for that, Scott. And we have one last question. I did, just because I know we're running over time, I did just want to call out if you can take a minute, 60 seconds. I just sent a link to a form to complete just to let us know how we did, how we can improve, and who you want to hear more from. I appreciate you clicking that link. Last question, I believe. Can I use cash value policy to purchase a home if I don't have a 401k?
Absolutely.
Yeah, absolutely. All right, you want to take that, Otis? Yeah, so if you've accumulated enough cash value where you can tap into it, yeah, that's absolutely an eligible source for a down payment.
Fantastic. I think that was it. There's a big round of appreciation for our time, our contribution. Is there anything anyone wants to add before we conclude the call? Jane came in just right at the final hour. Let's see. Why would someone do 1031 instead of a cash out?
Tax deferral. So again, those capital gains taxes. So the way you calculate the capital gains taxes is it's purchase price plus improvements minus depreciation, and then the difference between that amount and the sale price. So say you've got $900,000 in capital gains and you cash out, you're going to lose 33 to 35% of that is going to go to the government in taxes. Whereas if you do the 1031 exchange, you get to defer those taxes and redeploy them and use them in your next purchase. It allows you more purchasing power, and usually you'll get a better return on your investment because you're able to make better investments, either a larger one or multiple. So there.
So cash out and refinancing, buy new investment, Jane stated. I'm not sure if that's a question or a clarification. But Jane, maybe what we could do is have you get in contact with Stephanie directly. There's no capital gains on cash out refi. So maybe actually you can, sorry, Stephanie, did you have a thought on that?
I deal with sales, so a cash out refinance would be something that doesn't have to do with the 1031 exchange that I'm aware of. I'm not sure what they're asking exactly. But if you sell your property and there are capital gains on it, then they would be taxed if they were not deferred in a 1031, that I'm, as far as I'm aware. If I'm wrong or incorrect, I'm happy to get some education because, we're always learning new things and maybe this is something I'm not aware of.
Well, let me
But-
turn on the audio. Can you hear me?
Uh-huh.
Jane, we can hear
Well,
you.
when you refinance a property, you're cashing out and you say the property is worth $1 million, you're pulling out 500 and you're buying another piece of property. When you do a 1031, it's the same thing, but what's the difference?
A 1031 is when you're selling the property, not just pulling funds out of it to purchase another one.
But why would you do one over the other? You're still going to be purchasing an additional property.
People have different reasons for doing the exchanges the way that they're doing them, or selling or choosing to exchange. It's usually something they should consult their tax advisor or their CPA. Lots of times people want to sell their property for multiple reasons. It's not in an area that's doing well. It's not going to be appreciating. They want to purchase two properties, so they're going to sell the one and buy two. There's little debt, a lot of appreciation. It makes sense to maybe sell that and leverage up. There's multiple reasons why people choose to sell or do a 1031 exchange. And everyone's got different reasons for making whichever choices they choose. If cash out refinancing makes the most sense to you, then that's great. That's absolutely what you should do.
Okay, thanks.
And I'll just add, if you're selling the property, maybe you need all the equity to level up. When you do a cash out refinance, you can't pull out 100% of the equity. There are limits. So that might be one reason.
All right. It's 7:50. At some point we had 65 folks on the call. We're down to 35. But in light of the time, I think we're going to conclude here. Once again, for anyone who has any questions or want to talk further with anyone, please feel free to reach out to us individually, fill out the form, and we'll get you in contact with the right folks. For the panelists, I am eternally grateful for your time, your expertise, and all that you shared today. I think the chat speaks for itself. We address lots of concerns and potentially questions people didn't even know they had. So thanks again and have a great night.